Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. This week, my guest on the podcast is Peter Hewitt, a regular to host with me and the manager of the CT Global Managed Portfolio Trust, an interesting vehicle that has two share classes, a growth share class and an income share class. And I'm recording this in London on Friday. So, Peter, welcome back to the Moneymakers podcast. It's been an interesting few weeks since we last spoke. Obviously, we've had the new Labour government settling in, or perhaps not settling in, would be a better say. We've had the budget, which wasn't particularly well received, I think it's fair to say. And we've had the election of Donald Trump in the US. So a lot going on. Why don't you kick us off by telling us where you think we are and what's been happening in the investment trust sector in particular? And we'll take it from there.
Well, Jonathan, let's start at the general election in early July. I think if you'd asked most investors at that stage, without favouring one party or another, what it meant was hopefully we moved into a period of stable government. There wasn't going to be a change in government, certainly for a long time, and therefore that could be viewed as positive, whether you like the Labour Party or not. And yes, July was quite a strong month. Good month for trusts, not bad for the equity market. But then the media picked up on the winter fuel allowance, which was removed. And again, whether that's a good thing or not, it went down not well with most of the media and actually probably the public too. Then there was all the freebies fiasco of various people in government. And that just kind of undermined a bit of the sort of feel-good factor that governments often have, particularly with big majorities, for a few months. And then we got to mid-September. And you start really from mid-September to the end of October and the budget, you had a series of leaks of various policies in the budget, none of which were really that well received. And the upshot was, particularly in October, it was not a good month for investment companies, not great for the market, and a lot of holders of investment companies, individuals, fearing capital gains tax changes and other tax changes potentially in the budget, were trimming or selling holdings in investment companies. And so there was a lot of supply of stock of a whole variety of trusts and really very little demand and quite negative sentiment. And so then we got to the budget, followed quickly by the US presidential election. And in November, the budget has not been well received by business across the board, not just farmers, but business in general. UK businesses, and a lot of them private businesses, and some in certain sectors like retail, hospitality, hotels, really are going to have a big increase in costs next year, which can't be good for profits. Probably some prices will be put up, not great for inflation. And bond yields then started edging up in the UK and also in the US. And the outlook for interest rate cuts from the Bank of England, yes, there will be some, but not nearly as much as we thought a few months ago. So all of that together has not been brilliant. But if you look at the investment company index in November, it's outperformed the All-Share. So what is this guy talking about? And it's the classic that there is a small group of companies, really big investment trusts led by Scottish Mortgage, who have performed very well since the US election. And that's because the US market has had a big boost. Again, whether it can be sustained or not, I don't know. But trusts investing in America, and particularly in likes of technology and the big companies, so Scottish Mortgage, Polarcap Technology, Allianz Technology, JP Morgan American, Monks, all billion-pound trusts. Scottish Mortgage, Pershing Square, the second biggest one. That's a huge chunk of the investment company index, have all done quite well, up 5, 7, 9% or more in November. Again, not sure if that can be sustained, but the rest of the investment company sector, particularly alternatives, but UK equity trusts as well, in the main, have lagged.
In the doldrums, definitely.
And discounts have widened. So that's where we are now at the end of November. There's a bit of fatigue about the outlook, particularly for UK equities, just what's going to happen next year. They are still very cheap. They're still under-owned. And I actually still hold to a positive outcome. And for investment companies, hopefully a really positive outcome. But whereas you might have been hoping for that to be November and December, it could still be December, but my feeling is it's going to be delayed into next year.
Yes, and also, of course, the pound has also been weak against the dollar, which has also helped boost the sterling price of some of these trusts. So yes, I guess if one puts that in a slightly longer context, what we could say was back in the autumn of last year, you and I and a lot of people were positive about the outlook. We thought that the discount trend was going to reverse, which it did do. We thought the interest rates might be coming down, which they started to do. But we've sort of run into the buffers, as you say, at least as far as the UK is concerned, or particularly in the UK. Interest rates are not as low as they were. And in fact, most of the improvement in ratings happened at the back end of last year. And so this year overall has been actually disappointing compared to expectations. I think that's what you're saying.
Yeah. I mean, the average sector discount hit its widest at the end of October last year, 19. By Christmas, it was at 40. And we were all kind of quite positive about life. Now it's sort of 15 and a half. But having visited 12 around about the election, it's actually come out quite a bit. And some sectors have been really quite badly hit. Some of the renewables are down quite a bit. Big discounts now. I mean, dividend yields, Greencoat UK Wind yielding over 8 and growing the dividend. But the actual share price performance has not been good.
You mentioned the renewables. Let's talk about them. I mean, they have been particularly disappointing, I think, this year, as you say. Despite those still handsome yields, they've been affected by the fact that we've had higher rates than people expected. We've had lower power prices than people were hoping for, it is fair to say. And of course, they're all trading at big discounts, so they can't issue any new equities. They can't reinvest. In many cases, they're maxed out. But yet we haven't seen any corporate activity either in that sector, which is perhaps the one surprise there.
Well, you're right, Jonathan, but quite a number of these companies have sold assets out of their portfolio in order to justify the valuations and also hopefully improve the balance sheet a bit. But you've not actually seen either takeovers or big mergers, which you have in other areas of the investment company market. So, yep, they're a bit friendless at the moment. They do offer really good value, but the old story with value, you can wait around for a long time until there's a catalyst which changes that. And also, NAVs have been edging down, as you mentioned there, on power prices, which over the last few months have not been good. So all of that is not brilliant for the alternatives, renewables, infrastructure, and the likes. And the share prices are quite sensitive to long bond yields, rightly or wrongly. They really are. And long bond yields stopped falling a few months ago. And actually, a couple of times they've looked like they might start rising a bit on fears of inflation next year. So we'll see. Good value, yes. Great dividends, yes. Not great share price performance.
I'm looking through a list here of the discounts across the infrastructure space overall. And in many cases, these are now higher than certainly their average over the last few years, but particularly compared to before the Russian invasion of Ukraine, when they mostly traded at a premium, were able to issue lots of shares. So you obviously own some of those. I still own a couple of them. I got rid of a couple, I'm happy to say. But so they weren't doing particularly well at the time. But in your income portfolio, there's still a very...
Yes, and it's difficult to lose them in a sense because the dividends, I'm actually still quite confident about the dividends. And actually the wider income portfolio, the good part about it has been and will be the income. The portfolio is yielding over 6 and quarter, 6.5. The dividend is going up 2-3%. The shares trade at a modest premium. We've been issuing stock. The actual total return is probably behind the all-share index because it doesn't have, let's say, polar cap technology, which doesn't yield. And so it's got a lot of UK equity income trusts, global equity income trusts, some alternatives, some private equity trusts that pay a dividend, and they too have seen discounts widen. And actually that has been a big theme of mine. It's been okay. But, we were in London on Friday. I visited Oakley Capital yesterday. Oakley Capital is a really good private equity trust. His discount is going back out to the mid-30s. The NAV was up 4% the first half. So that implies it might be up 7, 8, 9 for the full year. Who knows? So my point being, asset values are now beginning to accelerate. Not rapidly, but if they'd been going sideways to slightly down for a couple of years, they aren't anymore. The exit environment is beginning to improve, which is good. We're not talking about big increases in valuations. The underlying companies are delivering good EBITDA growth, but the shares are still friendless. Now, what I would say is that is a sector that will really benefit from cost disclosure reform, which is something that's dear to your heart, Jonathan. And
I was going to come on to that because we've had a sort of good news, well, not totally good news developments in that area. We have seen positive steps to try and resolve this issue, but unfortunately we seem to be still bogged down in the mud of actually completing this transition to a world where cost disclosure is more transparent. That will be your view as well.
Definitely, and I mean, it's not going on forever. Until the second quarter next year, hopefully this bill will finally get through Parliament. Until then, there's an element of confusion, that people know it's changing, and that's great news for private equity trusts, which are really badly treated. It's great news for managed portfolio trusts, where our KID cost went from well over 3 to now circa 1, which is where it should be.
But that's not the sort of thing that changes sentiment or share prices overnight.
Just like that, as Tommy Cooper used to say. But nothing has actually changed. Are you one of the trusts that has an issue with the platforms in the way that they are still requiring a number of trusts to report the old higher cost number, even though the companies like your own are free to actually put in a 0 or a lower number?
Yes. Well, we did get a Think deplatformed temporarily by
Fidelity, but actually otherwise, no, we've been all right in that regard. And platforms are very important. I mean, there's quite a number of trusts where there's a huge chunk of the share register resides on Hargreaves Lansdown or Interactive Investor. But that is the big fear of a lot of trusts. If they put 0 in the box of their EMT form, then that doesn't compute for Hargreaves Lansdown, and you'll get deplatformed, Mr. Investment Trust. And nobody really wants that, but it has happened. Now, I think this will get resolved, and Jonathan, I'm reasonably confident in that.
there's not great short term.
It's not very short term. And it appears that not many investors are kind of front running this change, which even if it's coming and is actually positive, you would think that people will be starting to buy things now in anticipation of that. So maybe there's still an element of doubt about how and when it's going to happen.
Well, listen, the way I would view this whole cost disclosure issue is it's removing another obstacle not to buy investment trusts. Now, that doesn't sound desperately positive. It's not really, because it will take quite a while, mainly private wealth people who had to their clients, say, oh, such and such a private equity trust, the costs appear 6% or something, which is huge. And yet, how do you reconcile with really very strong NAV performance over the long term? But nonetheless, it will be a positive over the next year, probably 6 months. But in the short term, I don't think it's making much difference at all.
So let's just stick with the private equity trusts for a moment, because you mentioned those and the fact that a lot of them may benefit from this change. I don't track them all, but I track quite a few here. I've got about 15 to 20 here. And it's still very curious. We have 3 trusts that are trading at a premium, which are 3i, HG Capital and Literacy Capital, though that too has seen a bit of weakening recently. And all the rest are between more than 20% out to 40% discounts. Now, for a lot of them, of course, they have been trading around that level for quite a long time and historically have never traded at a premium. But if you were on the board of a private equity trust and you're looking at this, most of them announce new capital allocation policies. You know, we're going to pay down debt or we're going to buy back shares or whatever we're going to do. But do you think they might reach a point where they actually think, well, this game is not really worth the candle? I mean, we're doing all this activity and the shareholders aren't rewarding us for it, so why do it?
It's possible. It would take some while, though. I mean, cost disclosure, which let's say happens in the first half of next year, is a positive and opens the way for other groups to start buying private equity trust shares. Let's hope so. I think some of them could still improve their marketing, but I think are aware of that and are taking steps to improve it, because actually the retail public probably doesn't know what goes on under the bonnet very much at all. The long-term record is fantastic. I mean, HG Capital is my biggest holding in the growth portfolio. I mean, the NAV, I think, is up 11 or 12%. So it's the best NAV performance. It's reflected in a share rating, let's say, round about par. And they've done really well, but not many others. I've actually got Literacy Capital, which went to a discount, but has now rallied back recently. I think that's got a great opportunity. And Jonathan, can I point out, 3i is not a member of the AIC. So it presents itself as an investment company, but it's not in the index. So here. But there's lots of other private equity trusts. And my point is, I said with Oakley, but I think it's true with Pantheon and some of the other ones too. The NAVs are beginning to get some positive momentum. The exit environment is gradually improving, and the underlying businesses are doing quite well. So all of that tells you, if your private equity trust is on a 30 or 35 discount, and if that discount goes to 40 due to the NAV going up, and then looking like it'll go up again, maybe making the discount 45 or 50, I think that's where you will see share prices hopefully begin to respond, and potentially could significantly respond. But although most of these trusts are growth trusts, is what they do, their share prices are in the value category, and that takes a long time sometimes to correct itself. But listen, I'm personally quite happy at owning these things now. It would be great if we saw discounts starting to come in a bit.
Indeed, it would. I'm thinking, for example, which way I'm going to count this as a private equity trust because it has significant private equity exposure, but something like RIT Capital has, I think, made some positive noises. They've tried to do more in terms of communication and disclosure and all the rest of it, but it doesn't seem to be cutting through just yet, to take just one example out of these. And so basically the message is you want the boards to keep on with this new policy, both in terms of capital allocation and disclosure, but it's going to take some time, right? It's not going to be sold overnight.
It does take time. And they've got a new management team. They're certainly upping the game in terms of communication, which they needed to, because RIT Capital is a wonderful trust in the long term, but not many people really knew what was under the bonnet. And I think there probably is a good story to tell. And on a discount of thick end of 30, I just think the downside the likes of that is very limited. And you could have some quite material upside. But interestingly, that should be a steady performer. The NAV up 5, 7, 9% or something like that. Not up 25 or 30, which kind of undermines the whole case for RIT Capital. And so when I say that, that probably means the recovery is going to be protracted, and you'll see the NAV every 6 months, hopefully responding. But it's not suddenly going to shoot the lights out. And if it did, you would be concerned at what was under the bonnet.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. One bright spot in the sector, if you included in the sector, some of the growth capital trusts. So we've seen Schiehallion do well, and we've seen Chrysalis do well, particularly well in terms of discount narrowing and so on. Is that a sector that you look at, or is that too risky for you?
I've got Schiehallion, which, as you say, has responded quite well. And I think probably because the discounts got so wide that it was really sort of north of 50%. And so they've had better news with underlying holdings. And things have responded. They're still at quite wide discounts, though. But the shares have begun to respond, no question.
Indeed. I mean, it is true that if you look across the sector as a whole, I'm just looking at the numbers here in terms of share price changes year to date for private equity, the ones I look at anyway, most of them actually are positive. but only by us 1 or 2, 3, 4, 5%. There are some which have done particularly well. So Chrysalis, Schiehallion, HT3I, and Seraphim Space, which is the most volatile. You need to strap yourself in with that one. It's very up and down.
Yes, indeed.
So, I mean, that's one of my themes, private equity. And I would say so far this year, it's kind of been okay, because I've got a big holding in HG, but no better than okay, because a lot of the other ones, when you say up 0, 1, 2, 3, 4, remember the FTSE total return year to date is over 10%. It's nearly 11. So they're lagging. And UK equity trusts, which is the other one, generally, NAVs have probably been okay, but share prices, there's been a few, Fidelity Special Values, for example, but quite a few of the others are also lagging. And that could be put down to the discounts widening. Now, one thing I do want to say, I attended yesterday in London. Fidelity put on a very interesting event celebrating 30 years of Fidelity Special Values. It's only had 3 managers, Anthony Bolton, who was there, I think it's Sanjeev Shah, and Alex Wright, who's done that now for a number of years. And it was great hearing him talk. Anthony Bolton, tremendous investor. Alex Wright, he's a really good fund manager, and they just had great results, well ahead of the all share. But it was Anthony Bolton said one thing, and this really has resonance. He was saying that actually the environment now, and probably going forward for a while, should be great for active managers. And if you think about it, what's driven performance in America? The largest 5, 10, 15, 20 stocks. Actually, what's driven performance in the UK for the last few years has been the largest in FTSE. FTSE is outperforming the 250 and the small cap index and the AIM index considerably. So for active fund managers, there is a chance that they should hopefully deliver some decent performance at some stage over the next couple of years. And where does that leave your index funds and your ETFs? Just when you think, oh dear, investment companies, we are not sure if they really have a future, that's exactly when you should be considering them. Because the good fund managers will actually take advantage of the concentration of performance into a narrow few stocks. Leaves a lot of other interesting potential.
I guess it's fair to say that's one of the other dogs that hasn't barked so far, particularly is in the UK, and a lot of people are very excited about small cap and mid cap. But I think the government and the budget and all the furore around that has rather dampened enthusiasm for that. But they still, on any kind of longer term view, they look attractive anyway, for sure. So out of those, do you have any particular favourites out of those, I'd ask you?
Well, I saw on Wednesday in my office in Edinburgh, I saw Aberforth, and I think that's a really well-placed trust. It's on probably a double-digit discount, Jonathan, and is just really well-placed. They're noticing quite a lot of M&A in their portfolio, which is to their benefit. And I think it's interesting, trade buyers and private equity buyers still see a huge amount of value in the mid and small cap area of the UK market. So yes, they've lagged performance-wise, but I think all we need is for a little bit more confidence that we're not heading into recession or interest rates going up or whatever, could actually be the trigger for better performance from that area of the market. And that's when active fund managers really earn their corn. And some of these trusts, Mercantile is on a 12 discount, or James Henderson's Lowland is on a 12 discount. And that is really quite wide. They should be on much narrower discounts. So if the NAV turns round and starts beating the all share, the share price could really have a rare old surge. Now that may not happen, Jonathan, but
There's a good chance it will do at some point.
Meanwhile, we've seen a lot of consolidation across the UK equities sector generally, a lot of mergers, some winding up, some takeovers or new management deals, one should say. And you mentioned Saba Capital, which was this American fund that came in and started buying up a lot of UK equity trusts at a big discount and pressurizing the boards to do things. And in some cases, their involvement has got pretty significant. I think, is it Henderson European? They were up to nearly 30% now in that one. Do you think they're getting impatient for more action, or do you know what their game is?
I don't, and I don't think many people do. And it's actually the European Small Companies Trust, which Henderson does run, where they've got 29, but they've got over 20 in Bailey Gifford US growth. big holding of 18 plus in Edinburgh Worldwide, Herald and others. And what I think a lot of participants can't quite understand is they continue buying as discounts have narrowed from quite wide then to mid-teens, single figures, and they're still buying at discounts of 6, 5 and 4. So I'm not sure. But yes, there'll definitely be some more corporate activity in terms of forcing boards to maybe have big redemption opportunities. Maybe that's not a bad thing, but I mean, it's not great because you could actually see certain trusts, which are actually quite good trusts, disappear on the back of it. So you just have to be aware of what's going on there. They can be very good for share prices, can I just say? And there's certain ones, Herald and Henderson Opportunities, discounts tightened in a lot, and the shares have responded quite well. And they're both sizable holdings in Managed Portfolio Trust Growth Portfolio. So in one respect, I've got a smile on my face there, but I really would not want to lose Herald. I think it's a unique vehicle and not one that we'd like to see no longer with us.
You mentioned some things you've done. In terms of this background you described, where we've had a sort of waxing and waning of sentiment in different sectors, have you been making many significant changes to your portfolios? So let's start with the growth one, and then we'll talk about income one.
Well, the answer is not much, Jonathan. I've not introduced any new holdings for a number of months.
I've been top-sizing and adding a few. So I've added a bit to JP Morgan, UK smaller companies, growth and income. I've added a bit to TR Property, which I think when it yields over 5 and is on a bit of a discount, as a great manager, I think that is one to consider as well. So that's been the type of thing you'll be doing. I actually added a bit to Scottish Mortgage as well. So where you see performance hopefully turning, or in areas you think will turn, that's where I've been perhaps adding a bit here and there. And in the income portfolio too, there's been one or two opportunities to get more income-y type. I mean, equity income funds, you can find them with yields of 5, with good dividend growth. And then you can go much higher up the spectrum to renewables, credit funds and the likes, where yields are 7, 8 or more. I don't think you get much capital growth. But if the discounts tighten, you would get some capital growth there. But certainly the income is good. And it's quite interesting. The Managed Portfolio Trust is a good yardstick. It's got a growth portfolio and income portfolio. The growth is doing better. It's probably about in line with the all-share year to date, which is not bad, plus 10, plus 11. But we've been buying back shares consistently. So it's 100% retail, and they are still selling. The income portfolio has done okay. It's in positive territory. Let's say it's roughly plus 5, but it's been issuing stock. And so investors love the income.
There you go. That's interesting.
So the retail investors still love a yield.
They do.
Regardless of what happens to interest rates and so on, they tend to stick with that. Yeah, that's interesting. So then let's just briefly turn finally to the outlook for next year. You alluded to this a little bit. The US market obviously been so dominant in global returns. Do you share the view that that has become a kind of bipolar opportunity? Because we know what Mr. Trump says he wants to do. He has to be very clear about that. We don't know whether he's actually going to do all those things, but he wants to put tariffs on. He wants to cut taxes. He wants to fire half the government administrators and deregulate. Let's put it this way. It's a very radical agenda if he actually does that. So how would you interpret that? The old saying is, if Wall Street catches a cold, then we all suffer as a result.
If Wall Street was to really go into a bear phase, it would be difficult for other markets to be having significant positive returns. I mean, America, it's so uncertain at the moment. What do we know? We know that the forward PE is pushing 22, which is high, but the earnings growth is the best of any market by some distance. I mean, it's well into double digits. And actually, I think that's probably a pretty good chance of being delivered in 2025. Now, one of the reasons it's up there is you've got your Magnificent Seven, NVIDIA, Microsoft, and all of these names, Meta, and etc. And I'm sure listeners would love your upcoming detailed podcast on artificial intelligence, Jonathan. But that has driven, and I had Ben Rogoff in the other day, and clearly there's a huge change going on here. But these companies are forward ratings of 30 to 40. They are growing their profits and earnings, absolutely. But I think the one thing that will definitely happen is volatility. So you could have quarters where some of these big technology stocks really do a minus 20. And you think, oh my word, is that it? Because they maybe slightly missed a quarter. And then you could have another time when they do a plus 20 or plus 30. So I think you've kind of got to try and, if you're going to be invested there, and I do like the secular story, stick with it, but maybe don't completely get carried away and overplay it. I think where we've maybe been a wee bit disappointed actually is the prospects for the UK. I still think it's quite positive. Lots of companies buying back shares, that's good. Good dividend yield, that's good. But inflation and the macro is not as positive, and hopefully profits and earnings will come through reasonably well. But there'll be some sectors where growth is delayed because of the cost side of things going up, where they employ a lot of people. But I still think the UK, when things hopefully calm down a bit in the first quarter, that we actually do see some NAV pushing on. And hopefully some relative performance better than FTSE. And actually, so somebody else I saw recently, Job Curtis of City of London, and that's a very solid trust indeed, great dividend and pretty good capital performance. It's beaten the all share 1, 3 and 5 years. He showed me a chart which said that since interest rates started going up in December of 2021, so nearly 3 years ago, since then, the FTSE has almost but not quite beaten the MSCI, All Companies Index. It's only the last couple of months where it's fallen slightly behind. And that is staggering, because we thought, oh, surely not. But actually, interest rates going up, now at 4.5, 5, that's a value market. And the UK is a value stock market. Oils, banks, tobaccos, telecoms, you know. And so maybe it might be at least a following wind for the UK in 2025. Let's hope so. And there's certainly some interesting discounts for some of the well-run investment companies. I mean, even Fidelity Special Values is on an 8 or 9 discount.
That's 7 points better than the all-share in their results. That's not too shabby.
That's historically a very attractive discount for that particular trust. And there are other examples, you're right. Just finally, complete that picture then. We've got the US, we've got the UK, other parts of the world, Europe, emerging markets, Japan. And we said at the beginning, everybody got really excited about Europe at the beginning of the year. They're now sold off significantly.
Yes.
Japan is interesting. I think there are a lot of things going on there. And obviously China is interesting. Are you tempted to play any of those fields?
I'm not tempted to play in China. I mean, I don't mind owning a fund. So Scottish Mortgage has got, 10% in China. That's fine. There are some good companies. But there are a whole lot of reasons. Demographics, the property, horrendous debt, and then you've got an authoritarian government. Things might be okay, but they might not be. And I just think that should be on a much lower rating. I've been more interested in India, which has got much better macro dynamics to it, is a democracy, but the market is very highly rated. So I'm not sure. I think that's why I feel at some point, Jonathan, before the two of us go to meet our maker, we've got to be talking on this podcast about how the UK has been the top performer in the major markets over the past 12 months. Although, what was it Joe Curtis said to me? In the 1970s, 1980s, 1990s, and the first part of the noughties, the UK relatively outperformed the rest of the world. Not by much, but it did in each decade. Since 07, 08, huge underperformance, massive underperformance. Maybe we're just forming a base, and let's hope we get some relative outperformance going forward.
Let's hope so indeed. So that was Peter Hewitt, the manager of the CT Global Managed Portfolio Investment Trust with its 2 share classes, growth and income, talking to me this week on Friday.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.